Welcome back, everyone. I'll now just turn the meeting over to Preeti and to the Emerging Issues Subcommittee to hear our report backs from our earlier breakout groups. Preeti?
Great, thank you so much. I think we'll just go in order of that slide, if that's okay. So David Fabricant, can I call on you first to report back?
Yes, sure, Preeti. Let me just get myself centered here. There we go. Oops. All right. We had a good discussion in the breakouts. I'll remind everyone of the questions that we asked ourselves, and then I'll give you a quick debrief on conversation. How do companies use AI in preparing financial statements? Could be process controls, books and records. What are the risks? And what makes the features and its use reliable? What are the potential future opportunities for financial statements, and what are the risks related to those such opportunities? So we had a good discussion. We started with kind of what's being used right now in the financial reporting domain, and probably won't come to a surprise to most of you that we feel like there's not much in place right now. We think a lot of companies are talking about uses, AI use cases and generative AI use cases. We'll talk about those in a second, but I think amongst our group, we felt pretty good that there's not a lot in place and operational right now, but there's a lot being evaluated. We talk a little bit about see more examples of use cases being used across other areas of finance, like financial planning and analysis, maybe in treasury organizations and things like that, which makes sense. And then, of course, we talked about how AI could help us evaluate and record transactions, could help us with controls and process efficiency, and covered a couple of different angles about what AI could look like in the future. And that kind of got into a really good and lengthy discussion about the potential future use cases. And there was some examples of those back in the white paper that was included in your meeting pack. But just to name a few of the things that we talked about. One person raised just comparing disclosures of your 10Q or 10K and evaluating that against other sections of your 10Q or K, like your risk factors, cautionary notes, things like that, and where you could see the financial statements and the way you've characterized things or disclosed things. Are they in sync with the way you've described risk factors, uncertainties, things of the like within the document itself? We talked about identifying inconsistencies within the document and comparing those across other peer company filings, whether it's on a 1-quarter lag or as real time as possible. But you can imagine that, if you have a particular issue in a particular industry, that if you could do a little bit more real-time compare and understand how you're filing and disclosures compared to those in that same peer set. Are you more robust with your disclosures? Are you lacking in your disclosures? Is there something that you haven't even thought about that maybe your peer companies have more real time before you filed or right after? That an AI model could certainly help you do that. One participant even noted that investors are already doing that with their filings today. They're running it through AI and doing a tremendous amount of comparisons across peer groups, company sets. And so why aren't preparers doing that equally? We talked about taking your document and creating a model that would run it through the gap checklist. Could that then quickly and take the place of some members of our teams that are going down the checklist one by one and confirming or describing why something's not disclosed? Could an AI model do that? Certainly could be false positives that would come out of that. It would certainly need someone to review that, kind of a human in the loop, if you will. And you can imagine there's lots of disclosures that would be on the checklist that maybe just don't apply to you. So it would say that you haven't met it, but that would be an okay outcome. So like helping to strengthen the gap checklist. We talked about could it write the first draft of MD&A for preparers? The very easy this line went up by X amount and these three things were up or down. That's usually the first baseline construction of MD&A, and then hand it off to someone in the team to refine and check and make it more robust. That led us into a little bit of a discussion around the importance of users entering the right kind of prompts. And if you think about AI in a prompt bar, would someone put in the right prompts to get the right output? And I'll talk a little bit about that more when we come to the risks and reliability. But that kind of took us in an angle of it's important that people understand the right way to craft a question in an AI model to get the right output or the highest probability of the right output. We also talked about an AI model that could do contract evaluation, especially if you're in a company that has hundreds or even thousands of contracts, if it's a contract-heavy business. Think about the RevRec model and trying to interpret the right key components of a contract and apply the RevRec model and help drive an accounting outcome that somebody then could take, decipher, and finally make the decision on. We talked about an AI model doing technical gap evaluations of a fact pattern, even writing technical papers that the accounting team today prepares. And then could you expose all of that internally within the finance team for people to do research on, again, through a prompt-based AI model. And then you could really help people evaluate accounting transactions. You don't have to have it sitting directly with the accounting policy team or the real extreme technicians, and they could leverage an AI model just internally within finance. Interesting, we had one person indicate the SEC climate rule. And one of the big challenges there, if this is eventually passed, is defining weather-related events. And could an AI model actually help you do that around the world? They're all different. They all take different forms. And could that be an enhancer to capturing weather-related events? And then finally, Preeti, on kind of risks and reliability around all of this, we kind of clubbed together in a conversation. We started off by talking about kind of what really are the skills of the auditors and preparers of the future? Are they dramatically going to change? Is the core auditor that starts in the auditing profession or the first staff accounting role you may have in a company still the same skill sets that are needed? Largely, most of us believe that is true, but we will also have to upskill talent and bring in some other talent with different skills around kind of this technology and these concepts to help supplement the teams that we have today, both on the auditing side and on the preparer side. And this is where we dived in a little bit more about user prompts. And as you all know, if you go into ChatGPT today, you type the same prompt with just a slight variation, you can get a very different answer. And we talked a little bit about how you can license users within a company to use a Gen AI or large language model built piece of technology, and how can you train them and certify them, even have them be recertified so that they are an appropriate fit for purpose user. Instead of opening up a piece of technology to everyone, could you actually get really specific and intentional about certifying user ability? That'd be a way, that's a risk, that'd be a way to make it more reliable. Same with like data manipulation. That's obviously a risk. It can be more reliable if you put controls around how data is ingested into the model, who's making the decisions on what data goes into the model, and how is that data always kept current so it doesn't, and we talked about this earlier, all of a sudden become naturally biased, and that starts to build upon itself. We had an interesting chat around kind of bad actors, and if you're in a company and you have an intention to do something wrong, is it actually easier if there's a Gen AI or an AI model helping produce outcomes? Is it easier to manipulate that data, find a different person to collude with or partner with to potentially try to get the outcome that you want? So I think the risk of collusion is different as at least the way that we would typically think about it, if these become very prominent and used within companies. Obviously, we talked about change controls and the need to elevate those. Access controls, back to data, becomes super important. How do you think about that? It's a risk. It can also add reliability if you get it right. And really interesting, someone in the team mentioned kind of like an internal whistleblower program over a Gen AI model. And kind of like if you see something, hit the big red button, raise it right away in an anonymous way. But I thought that was not something that had crossed my mind. Obviously didn't say it, but a very interesting and a way to be very serious about this. If you're going to actually use it and let it go, have a way for people to raise concerns right away and have that be in your mindset, in your culture as you deploy this technology. So again, a reliability factor that could help, but plenty of risks, plenty of opportunities. And we know lots of companies are thinking about it, but not much is happening right now. I don't know if anybody else in the group wants to correct anything I said that was wrong or add any additional flavor, but I tried to pick up all of the conversation.
Okay, thanks, David. I forgot to mention in the preparatory materials that you all got, we took the liberty of converting it into a podcast. I don't know if anybody heard the podcast. It was generated by AI. It was pretty interesting because I think you got to see some misuses of the information, but then also some value to the podcast format and having AI do that for us. So sorry, I forgot to mention that, but I just wanted to remind you that that was a nice way to kind of see AI being used real time. So to move the discussion along, thanks you so much, David. We will move to the second group, which is Brian Proto.
Yep. Okay, great. Thanks, Preeti. And just for anyone who didn't yet watch, and for those who did, thanks to Dane. It was a group effort, but thanks to Dane especially for some of the work on that, which I think actually we really just took from the PowerPoint deck that is public, and it was actually a first version of it. And the irony of some of that was that we actually ended up liking the first version on the PowerPoint deck that had not yet been fully evolved versus the final PowerPoint deck where the podcast didn't come out as well. So it just shows you the importance of human involvement. Notwithstanding, we feel we have a better quality product with the final deck. The first deck produced a better podcast, and it even figured out how to fix a typo. We had collision instead of collusion, but it appropriately worked collision into the podcast in a way that was actually very very normal and appropriate. So lots of interesting learnings there. And you could even think about how you could begin to use that even in developing training and other things, again, with the right human involvement. But anyway, in terms of auditor use, we had a very robust discussion. I won't repeat a lot of what David said, but I'll give some links back to it, because I think from an auditor perspective, not only do auditors have to think about what preparers are doing, but I think a lot of the use, the current use anyway, by auditors is there's a lot of similarities and themes relative to the thought process and where things currently stand. We had a lot of discussion around training, the importance of auditors understanding and being able to identify when AI is being used, having an understanding of what it is, what it does, firms having governance policies, guidance, appropriate use cases for engagement teams, an approved set perhaps of established tools for which engagement team members can actually use AI, as opposed to making sure they're not using something that's inappropriate or not approved. We talked about transparency and knowledge between preparers and reviewers of when AI has been used in performing work, so that reviewers can take that into account. We talked about importance of transparency and interaction with management and audit committees relative to their use, relative to our audit, but also the auditor's use relative to conducting the audit. We also talked about ways in which to begin to identify management's use of AI, the considerations when management might be beginning to use AI relative to controls and financial reporting, and the implications of that. As David's mentioned, our own experience has been that it's relatively rare, although with the human in the loop and the right human involvement, there are use cases that we've seen implemented, but that certainly could result in there being a material weakness if not controlled appropriately with the right human involvement or the right monitoring. We talked about relative to firms, again, and auditors, moving on from training maybe to uses, firm level tools, if you will, versus those that might be AI enabled tools such as Microsoft Copilot or other tools that are being used by that can be used with the right policies and guidance and the like by engagement team members. We talked a lot about it as it being, and different people described it in different ways, almost like an assistant or an accelerator to the work performed. We talked about it being in some ways maybe incremental versus reliance, and certainly relative to providing good first draft or material or content from which one might work from. We talked about identification of anomalies. We talked about drafting helping to draft memos, summarizing results, making standardized updates to documents, formatting or converting data for further analysis. And used properly, we talked about its ability to improve audit quality, value, and really the efficiency in the audit, and really better focus humans on the important issues and judgments. Again, early stages in many respects, but the human involvement and ultimately the responsibility and accountability for the human, all the way up ultimately to the engagement leader who has final responsibility for any audit report that's issued, that wouldn't, shouldn't, and has not changed, notwithstanding how technology, including AI, would be used. We talked about sort of lack of methods today for really comprehensive monitoring and evaluating of ongoing effectiveness in an efficient way, which really leads to there being the constraints on the extent of use and reliance beyond some of the things what I've described. Although we know that many firms, including our own, are working diligently in that respect and thinking about that as we develop, for instance, our next generation audit. And I know other firms do similar things relative to thinking about audits of the future. Notwithstanding, there are some tools today that again appropriately use Gen AI in limited ways or with the right human involvement. We also talked about the importance of evaluating the nature and extent of audit evidence that one ultimately obtains, and that there could be some differences in how one thinks about that relative to then evaluating the sufficiency overall of that evidence to support an audit opinion. We talked about the risks, including data reliability, relevance, completeness, and accuracy, and back to some of David's points just on the bad actor point, just the intentional or unintentional inclusion of bad data, which could help achieve a result or could end up in an error result. We talked about governance of data, confidentiality, data ownership, legal considerations around that. And so all in all, really, I would say a similar type discussion to the issuer discussion, important role for AI to play and continue to play and grow over time, but really at the early stages, and a lot of cautions about the risks as we think about the use in the audit. So, Preeti, I think that's I won't belabor some of it because I think a lot of the points would be more similar to what you just already heard from David, but I think that gives an overall summary of it, and certainly anyone from my group could feel free to chime in if I've missed something they wanted to add.
Okay, thank you so much, Brian. So the next group was my group, and the questions we considered was, how does one consider the potential fraud risks from AI, which can be used to create fake content? What is reliable audit evidence in the wake of this possibility? Can AI be used to detect fraud, and what potential future opportunities are there to use it in that capacity? So briefly, we touched on some of the questions discussed in the other groups, and just one or two sentences about it is that we kind of agreed that a starting point is to understand what management's process is for using AI within the company, and that the observations right now are that employees are using it as a tool to speed up analysis and evaluation, but that human judgment and review is still in place. It's not really taking over the whole process yet. And that most companies seem to be developing their own tools internally because of the data privacy issues to get around them. So then we moved our discussion along to the potential for fraud. I think our group generally agreed that the potential for fraud is sort of exponentially an issue in this new wake of AI. There's a lot it may be a lot easier to create deep fake documents or even deep fake identities. You may not even be sure who you're talking to in some cases. And one specific suggestion that was brainstormed was to consider whether management representation letters need to adequately address the authenticity of documents and be revised accordingly. Then we talked about how with this issue that is prevalent, it is important to still focus on the basics of auditing. That is, many of the deficiencies the PCAOB uncovers in their inspection process are important anchors for the audit in the wake of this issue. There are certainly some tools that firms are using. We talked about Benford's Law as like a widely applicable tool to evaluate fraud in a variety of documents, but then that there's a number of other tools firms have generated internally that do, analytical procedures to try to evaluate what kinds of anomalies are there in the company or client's data. But that one issue with using these tools, while it's great and it can provide people to direct their attention in the right place, it also creates the potential for false positives and some challenges with how you interpret the data. And so that is something having some discussion either within the firm or from the PCAOB, either way, about how to think about those false positives might be useful. We talked about the role of external confirmation becoming even more important in the wake of these potentially deepfake documents. And that a second aspect of that is to bring more skepticism to the audit. And we brainstormed some specific ideas on how to improve skepticism that I'll run through briefly. So first is to provide training on actual examples of things that went wrong within the audit firm, but also tapping some external resources such as litigation, the ACFE materials. There's also a COSO document on AI, and the AICPA working group on AI is working on a practice aid. It's not out yet, but it will be in the future, that some of these resources could be compiled together. And to the extent that the PCAOB could facilitate that or participate in that, that might be helpful. Creating these dragnet type presentations of the cautionary tale of what went wrong or what was missed, or how one could identify, the deep fakes, that could be helpful. We also talked about a second suggestion, which is in the fraud brainstorming sessions. Right now, there is some documentation that requires the team to focus on IT in that session, but it could be helpful to expand that to AI so that there's a direction to move the brainstorming session to consider that specifically. A lot of the firms, like I said, are compiling these analytical procedures to identify anomalies, and then they're taking that combined with the individual team's expertise of the specific client's business operations, and using both of those together can really enhance the fraud discussions. We had also discussed, in terms of improving skepticism, that the PCAOB could advocate for state boards of accountancy to require fraud CPEs. Right now, apparently the state of California does require that, but to our group's knowledge, that was the only state that requires this, but this could be expanded, and specifically at some point in the future to focus on AI as well. And then that it might be useful to, we like that the PCAOB has started this fraud resource page, but it may be further useful to compile the fraud issues related to AI and in review of the AAER. So that is, the compilation of those cases would be helpful rather than simply just having a place to find the cases. Other issues we talked about is that it's helpful to have regulators keep up regular communication and spotlights. For example, the IAASB has regular communication on AI, and people find that generally helpful. And then lastly, we touched briefly on the approach for governing AI. It seemed that our group's reflection was very similar to the total group's reflection, that they liked the approach of having the PCAOB require the firms to do this, and that this has sort of been started by the QC standard in some sense, the principle of it, that the PCAOB could review, their approach. But there are some concerns that were raised by the group. For example, that could lead to a system where inspections are kind of being used to set standards by review instead of having an explicit standard. And it also could mean that the principle-based standards just have too much judgment, and it's very hard to figure out how to apply it. And a third pitfall is that the smaller firms may not have the appropriate expertise and sophistication to really govern AI appropriately. So relying on them might not be as good of an idea. Okay, great. So that was our group. I'm going to now turn it over to Dane and Jim.
Great. Jim and I are going to tag team this, but I'll just read like our question. What we were asked to go through in group 4 was, should the auditor describe or provide any disclosure, either to audit committees, public disclosures in audit reports, et cetera, about auditing AI outputs, use of AI in auditing, or risks? And in the interest of full disclosure, Jim and I, we took the notes from our session, wrote them all up, and then used AI to kind of generate a outline. And so we're going to tag team it. Jim will take the first part, and I'll take the second part. So over to Jim.
We've got 3 minutes left to keep you on time, so we're going to go fast. At first, it was discussed that this is just another tool and described as a new shiny toy, which quickly led into the discussion that the really, really smart people from OpenAI and Anthropic and Google DeepMind are saying that artificial general intelligence will be here by 2028 to 2030 timeframe, and perhaps that puts another light on it. OpenAI defines artificial general intelligence that as being better than humans at most value-added work. So that's very interesting. And as it's been mentioned, the podcast for our prep materials was an AI podcast. There was a general hesitancy, I would say, at first for required disclosure, and that certainly fits the polling question that we had, where 21% of us thought a specific framework was not needed, 11% thought the PCAOB should provide a framework, and 58% thought that each audit firm should do its own thing, and then 11% thought nothing really to do. But as we get into the discussion, some participants argue maybe for some best practice guidance. There were participants aligned with the self-regulation camp, as I said, with the breakout question. Of course, investors are going to have different concerns than perhaps preparers and auditors, and there's a belief that best practice guidance maybe doesn't go far enough, and maybe there's a worry about the need for regulation beyond self-regulation and not wanting to kind of get to the floor. A reference was made, for instance, to the fair value valuations, where guidance came out that said, there's 3 realms of this. There's guidance, securities that you value under number 1, number 2, and number 3 risk, whether it's, right off the markets or if there's significant judgment involved, and perhaps, something akin to that, might be available for disclosure in the AI. And then there was a discussion of the PCAOB framework for AI could help us understand where AI is being relied upon for key judgment areas and tasks to critical judgment. And that led to a quick discussion of that there's going to be a natural tendency of audit committees, for instance, to want to be discussing AI in terms of how it is impacting audit efficiencies and audit judgments. And we didn't say efficiencies from the perspective of cost and money, but efficiencies from the perspective of being able to do greater audit procedures leading toward higher audit quality. And then there was a good academic perspective that, John, we appreciate you bringing us, that in his particular university, every professor, has to publish an AI policy. And the particular ones that we talked about were, pretty straightforward. How did you use AI? How did you use AI to then go beyond what AI found and add critical judgments to what AI provided to you? and how did you augment your decision making, by way of AI. And so that was a part of the discussion. That naturally led to a discussion of what does existing guidance tell us. And I think, Dane, you'll probably take that part. And I've left you about a minute.
Sure. Hopefully they'll give us a minute or two extra. But yeah, so Jeff brought up a good point that, raised the question. You have AS 1301, communication with audit committees, and he thought paragraph 12.2 might be relevant here. When you get into areas of accounting, significant accounting policy where there's controversial areas or areas that lack authoritative guidance or consensus, or where there's diversity of practice, that kind of triggers a conversation between the auditor and the audit committee. And he thought, well, perhaps a lot of these AI issues in this cutting edge and perhaps material level of involvement in the audit, this might be the provision that raises the bar and says, hey, these conversations should be happening between the auditor and the firm, which then also raised the question, as an investor, take it one more level and let us hear, some level of what those conversations are like and what those discussions are coming to. We then brought up the, maybe as a possibility for how to approach this. You have the PCAOB proposal that they released in April on firm and engagement metrics, and you have this proposal for this new Form FM, where you'd have disclosures of your firm level metrics, and then you have what we already have, our Form AP, but having it more enhanced, so you'll have, many metrics about the specific audit. Well, we thought maybe this is a natural place to have, for both of these forms, have discussions about what you're doing, either at the firm level on AI or on the specific audit. And I think what we do, a lot of the investors say we want to see specifically in the audit, have a box where they can have a paragraph and say, here are the material ways in which we used AI in this audit. And we thought that would be helpful, especially for investors, because that Form AP in particular could be like this place that the investor would naturally go to, where they'd want to have a conversation of whether they feel like they're getting quality from the audit. Because today, the audit is a bit of a black box. We know what we're paying, and then we have a sense for whether there's a history of deficiencies, whether it be internal control problems or restatements, but we don't really go beyond that. But if you then have these conversations about AI and perhaps cybersecurity here, where folks can kind of give us some summary of how these are approached, we'd have a really robust document that would really kind of lead to better engagement between investors and management and the boards. And then the last thing I'll mention, Jeff mentioned that there was that recent PCAOB document that talked about cyber security disclosures, and he brought up the point that the AIG had proposed that perhaps you could have some expanded disclosures there, but maybe AI could get wrapped up into that. So kind of linking these ideas together, maybe there's this opportunity through that project, you get some enhanced disclosures around cybersecurity, AI, and then maybe they get routed into the Form AP and the Form FM. And with that, in interest of time, I'll stop there.
Thanks, Dane. Back over to you, Barb. So we can't hear you, Barb.
No, thank you. Lots of great food for thought, everyone. I know that we're a little bit at time, but I do want to make sure that are there any members or anyone who wanted to add anything to the summaries of the discussion? Okay, well, if not, again, that was a great discussion. We have lots to think about. Well, that brings us to our last topic of the day, which is subsequent events. And subsequent events is now in our midterm project, and it addresses several interim standards. This project's led by Donna Silkner of the Office of the Chief Auditor, and Donna and Cheryl Hennig, also the Chief Auditor, are going to lead our discussion this afternoon. Donna, with that, I'll hand it over to you.
Thank you, Barb. Hello and good afternoon, everyone. So as Barb mentioned, Cheryl and I are part of the team on this midterm agenda project that also includes other OCA professionals, as well as colleagues in the Office of Economic and Risk Analysis. As Barb mentioned, this project is addressing several interim standards related to subsequent events and other matters arising after the date of the auditor's report, including the auditor's responsibilities related to subsequently discovered facts and reissuance of the auditor's report. And there have been several changes in the auditing environment since these standards have been adopted, including developments in the applicable financial reporting frameworks, adoption of other PCAOB standards, and advancements in technology. And shortly, Cheryl will provide some additional background on each of these changes. And from today's discussion, we're very interested in your views, experiences, and observations in this area. We're also interested in any academic research papers, external reports, or other information that provides additional perspectives on this topic, including potential economic impacts that should be taken into consideration. And the materials we provided to you include background on the standards subject to our discussion today, an overview of the relevant standards requirements, and the discussion questions. And before we dive into the discussion questions, I'll turn it over to Cheryl to provide a little more background on the standards and changes in the auditing environment affecting current practice. Cheryl?
Thank you, Donna, and good afternoon, everyone. Brian, can you please go to the next slide and the next one as well? Thank you. So throughout today's discussion, we are going to be using the terms subsequent events and subsequently discovered facts, and I wanted to take a minute to briefly describe what differentiates these terms. The first term, subsequent events, refers to events that occur after the balance sheet date and require adjustment of or disclosure in the financial statements. Financial reporting frameworks such as IFRS and US GAAP describe two types of subsequent events: those that provide additional evidence with respect to conditions that existed at the date of the balance sheet, and those that provide evidence with respect to conditions that did not exist at the balance sheet date. The second term, subsequently discovered facts, is focused on another date, the date of the auditor's report. This term refers to facts existing at the date of the auditor's report that the auditor becomes aware of subsequent events to the report date. Such facts might have affected the auditor's report had the auditor been aware of them. As shown in the slides provided in advance, the auditor's responsibilities for subsequent events differ from the auditor's responsibilities for subsequently discovered facts. Next slide, please. This slide shows the standards addressed by this project. The majority of the standards, except for AS 3105, are interim standards adopted by the board in 2003. The relevant paragraphs of AS 3105 are substantially unchanged by the auditor reporting project from the requirements initially adopted by the board on an interim basis. At a high level, AS 2801 includes the auditor's responsibilities related to identifying and evaluating subsequent events. AS 2905 provides procedures that should be followed when the auditor becomes aware of subsequently discovered facts. AS 3105, paragraphs 54 through 57, provide direction for a predecessor auditor that is reissuing or consenting to the reuse of their audit report. AS 3110 provides direction for dating the auditor's report for 1, subsequent events occurring after the date of the auditor's report but before the issuance of the auditor's report, and 2, reissuance of the auditor's report. AS 4101 provides direction about the auditor's responsibility when the auditor's report is included in the registration statements and other filings under the 1933 Act. And if we can proceed to the next slide, please. At a high level, this slide depicts the timeline for the requirements of the standards we are discussing. AS 2801, subsequent events, includes requirements such as conducting inquiries and reading certain available information related to identifying and evaluating events, including transactions that occur after the balance sheet date but before the date of the auditor's report that require adjustment of or disclosure in the financial statements in accordance with the applicable financial reporting framework. There is a period after the balance sheet date where the auditor must be concerned with completing various phases of the audit. This period is known as the subsequent period and is considered to extend to the date of the auditor's report. This time frame depends upon the requirements of the audit and can extend up to several months. We'd like to highlight that our research has indicated for most public companies, the date of the auditor's report coincides with the date of the issuance of the financial statements. And there are also a number of companies of all sizes whose audit reports predate the issuance of the financial statements, generally by a few days, and in some cases by a few weeks. So this slide is designed to reflect such situations. AS 2905, subsequent discovery of facts existing at the date of the auditor's report, addresses the auditor's responsibilities for subsequently discovered facts and requires the auditor to perform procedures to determine the reliability of information related to the subsequently discovered fact. AS 2905 is applicable during the period of reliance on the financial statements. AS 3105, departures from unqualified opinions, paragraphs 54 to 57, provide requirements regarding the report of a predecessor auditor. For example, before reissuing or consenting to the reuse of a report previously issued on the financial statements of a prior period, a predecessor auditor should consider whether their previous report on those statements is still appropriate. The requirements of AS 3105 are applied through the date of the reissuance of the auditor's report by the predecessor auditor. AS 3110, dating of the independent auditor's report, states the auditor should date the audit report no earlier than the date on which the auditor has obtained sufficient appropriate evidence to support the auditor's opinion. AS 3110 also provides that the auditor has two methods for dating the report when a subsequent event occurs after the date of the auditor's report. The auditor can dual date the report or extend procedures and date the report using a later date. Lastly, AS 4101, responsibilities regarding filings under the federal security statutes, addresses the auditor's responsibilities related to subsequent events procedures in 1933 Act filings. AS 4101 directs the auditor to their responsibilities under AS 2801 and extends those responsibilities through to the close as possible to the effective date of the registration statement. And now please proceed to the next slide. As Donna mentioned, since these standards were adopted, there have been several changes in the auditing environment. AS 2801 was adopted before applicable financial reporting frameworks were revised, and specifically both US GAAP and IFRS have added requirements for management regarding the identification and evaluation of subsequent events through the date of the financial statements are issued. These standards were issued before the PCAOB adopted the risk assessment and reporting standards in 2010, which includes AS 2110, identifying and assessing risk of material misstatement, AS 2301, the auditor's responses to the risk of material misstatement, and AS 2810, evaluating audit results. Lastly, auditors use technology-assisted analysis to a greater extent when designing and performing audit procedures. And now I'll turn it back over to Donna to proceed.
Thanks, Cheryl. So we look forward to hearing your views, experience, and observations related to subsequent events and other matters arising after the date of the auditor's report. So Brian, if we could skip ahead to slide 13 that listed out some discussion questions we provided in the materials in advance. we'd like to open it up for the discussion, and I'm going to use Danny to help me with facilitating. So we'll start with the first question with what are examples of subsequent events and subsequently discovered facts that you have encountered?
And Donna, I think in the instance of time, if you want to read through all 4 questions and then we'll open up the floor for all 4 at the
Perfect.
same time.
You got it. So question 2, if you encountered situations where subsequent events were identified by the auditor and not by the company, what were the subsequent events and what procedures did the auditor perform to identify them? It's question 3. So continuing our discussion on technology from today, how have advancements in technology affected the nature, timing, and extent of procedures the auditors perform to determine whether subsequent events have been appropriately identified and addressed by the company? And lastly, in your experience, how do the number and nature of subsequent events affect the audit plan and audit response?
Great, thank you, Donna. And
Thank you.
opening up the floor for those 4 questions, John White, if you want to go ahead.
John, we can't hear you.
Hi, sorry. I was going to start with question number 1 because that's the easiest for me. It seems to happen all the time. And the 2 categories of events that I find myself dealing with all the time are I'll call them jury verdicts, settlement discussions, other kinds of events or information that deals with something, a liability that was in existence at the end of the period. Settlement discussions, as you may know, are viewed, at least if you make a settlement offer, most of the accounting firms believe you need to accrue that offer, the bottom of the range, that being the offer. The other category that happens is some sort of, I'll call it catastrophic, weather-related or other event after the end of the period. A plant is destroyed by a tornado or some other, a hurricane hits Florida, whatever it is, but an event that clearly was not, or facts that clearly were not in existence at the end of the period. There's some other things that are sometimes a little less clear, such as things that might lead you to believe there was an impairment. And that might have been at the end of the period, or it might have been later. But anyway, I run into these all the time. The 2 observations I had, one is the place where companies actually worry about this the most is if there is a gap between their release of earnings and the filing of the 10Q or the 10K. Many companies file those at the same time, but many, particularly companies that like to report quickly, there is a gap, sometimes of weeks, between reporting earnings, which the audit committee gets involved with. You work it through with the auditors, but there's weeks before you file the 10Q or 10K, and you can end up with these kinds of events that I just described occurring during that time period. The audit report is, I agree, always signed at or right around the time of the actual filing, but the company is grappling with the subsequent event issue and whether and how to reflect it. The other place that I have found this to come up, and I'll try to say it delicately, but when there is a change in auditors, let's just say that the new auditor sometimes raises issues as they have a fresh look at the various accounting issues, that the accounting matters that the company has been following, and that they may look at things differently or lead the company to look at things differently than they were looking at with respect to the prior auditor. And that can quite often open up questions about what happens with the prior auditor and the audit of the prior years. Lots of possibilities there, but you usually have to come to a resolution between the two accounting firms about what the appropriate accounting was, or you end up with often a restatement of the prior years. But anyway, those are my examples and experiences in this area.
Great. Thank you very much, John. We'll move on to Preeti Chowdhury. Oh,
Thanks.
okay, there we go.
Yeah. So I looked over some of the standards and I noticed two things to consider. First is that the standards largely rely on inquiry, which is kind of a low level of audit evidence, in my opinion. And there might be ways to improve that by maybe forcing the auditor to have more of an informed discussion or inquiry. For example, guiding them to look at some analyst reports, headlines, specifically looking at changes in the market value of some of the investments, things like that. More specifically, because the risk assessment standard has been passed subsequent, is to tie it back to the risk factors of the company and of the audit to have the auditor really evaluate formally whether the risk factors have changed with respect to market conditions before they go into this inquiry process. Second suggestion to consider is perhaps to specify who should do the inquiry, that could lead to greater accountability. And the reason I raise these issues is I informally did a search in audit analytics on subsequent events and restatements. And there was about 50 that came up. I didn't review all 50. I just looked at about a dozen of them. But I do encourage your team to consider doing that as a way of gathering evidence. And a number of them related to, changes in the market value of investments, which had not been disclosed. That seems like low-hanging fruit for the auditor to deal with. But a number of them dealt with, I guess the greatest percentage dealt with what John raised earlier about the lawsuits or settlements and changes in those that had been omitted. So I don't know if John can expand on this. I'm picking on you a little bit. AS 2505, I think someone had mentioned, you may have made a comment about that previously in the SEAG about that could be improved and that could lead to maybe better disclosures here in subsequent events. So I'm going to pick on John again and see if he can chime in since it's his expertise.
Go ahead, John, if you have a response to Preeti's observation. If not, we can move on to the...
Preeti, I'm not sure quite what the question was.
So the question was, I think it's AS 2505 that deals with the auditor's communication with the lawyers to get information about the outstanding litigation that you were referring to. So when I did my random sample, I noticed about more than 30% of the cases of the restatements related to subsequent events were about the settlement of litigation or some update about the litigation. And I know there's a number of barriers to the auditor getting information from the lawyers in that process. And I wondered if you had any suggestions on how to improve it.
Yeah, actually, I mean, there's a whole protocol there for getting information from lawyers. I have, maybe it's because I look at it from the lawyer's perspective, but I have not thought that has been a particular problem. I mean, my sense is that the auditors get the information they want, not normally in the letter from the lawyers, which is very constrained. But if you go through the language of the audit standard, you can have conversation. You can support that with, a meeting, a conversation. And my sense is that the auditors and the company, very candidly, gets the information they need to decide whether an accrual, well, a disclosure, but it's usually an accrual, is appropriate. So I have actually not found that to be a problem area. What I have found, and it's not a problem area, it's just challenging when the facts change. And facts change during litigation. The obvious examples I say are settlement offers and jury verdicts. And then you need to get updated facts.
Okay. And Preeti, unless you had anything else on your comments, okay, then I'll hand it over to Christine Devine.
I just wanted to kind of follow on where John was saying he hadn't seen a problem in that area. Just overall, I would say I don't hear significant concerns in the subsequent events standards area. So that might suggest that there isn't a need for significant modifications here. I would say if there is modifications made to the standard, it would be helpful if the PCAOB were also to consider alignment with GAP. And the GAP standards here, and also alignment with other jurisdictions reporting, I think would be helpful here. John did it and Preeti did a good job of answering some of these questions. So I would add on those.
Okay, great. Thank you very much, Christine. And have a number of hands raised. So we'll go over to Steve Morrison next.
Hey everyone. So I think that when you consider subsequent events, it's not just going to be what's in the subsequent event standard where there is inquiry and there's also some additional steps that are in there, but it's also the consideration of all our other audit evidence, because there are a number of other procedures. Well, we did talk about the legal letter, but just thinking about the assets, what ultimately happened to that inventory? Did it sell? What the various cutoff testing that's done and so forth. So there are various substantive procedures which can contribute to your understanding of or the identification of subsequent events. And I'm kind of on the same page that with what Christine was saying. I'm not sure there's necessarily a need to make wholesale changes to that. I do want to throw out one thing that may be considered is adding in what's in PCAOB and US Gas from the related parties guidance, which is 241016, which basically gets to if you had previously unidentified subsequent event, previously identified related parties, there's a whole set of procedures, A through F, I believe, of what to do. And it basically gets to, okay, well, communicating internally to the engagement team, going back to management, saying to management, why did your controls fail to detect related parties? Maybe some guidance along those lines, which I think a lot of firms probably already do. Regarding subsequent events, if subsequent events are identified, but the entity had not previously identified those or disclosed those, basically reemphasizing to the auditor, find out why the entity didn't disclose that. Is there a reason the entity didn't disclose that? Is there something wrong with management's process for identifying subsequent events that we need to consider as a part of our audit? But I think other than that, I wasn't necessarily seeing a need for a wholesale change.
Thank you very much, Steve, for those insights. We'll move on to Sarah Lord now.
Thank you. And I agree with a lot of the comments that have been made. I don't think that this standard is one that we are seeing significant issue in practice or a need for significant modification. Very much agree with Christine's comments of, the more we can align with US GAAP and IFRS and other standards, the better it is to be able to implement, along with aligning with other auditing standards. When we look at one area that we do see, just adding to kind of the first question, I think John covered this very well. One other area we do see subsequent events come up is if there's operations kind of related activities approved by governance in that period after year end, but before the financials, thinking about how making sure that gets all the way through financial reporting. So might that affect an impairment analysis? Might that affect future projections and a going concern analysis? Making sure that those get tied together is an area we sometimes see management not always identifying that connection, and something identified by the auditor. And then Preeti, to your comments, I think one thing that could be really helpful for the PCAOB is to kind of look through and meet with firms, see what you're seeing inspections. I think a lot of the items that you called out that maybe the standard currently only requires inquiry, we are doing additional procedures pretty routinely beyond inquiry to substantiate that. And very simple use of technology is there's easy routines you can have to have your client's name or their industry come up and get those feeds sent to you, right? We all get millions of news feeds and emails. I think pretty much every audit team does that and has that set up to get the updates of what's happening, so they can double check that against what we're seeing, what we're hearing from our inquiries, what we're seeing from reviews of the board minutes and all the other pieces of audit evidence. And so I think that would be something where there may be some opportunities to add clarity to the standard that is probably codifying current practice. And then I guess I'm kind of thinking of that from the perspective of, let's make sure everybody understands what's happening today. And then if there is more that needs to be done, have that really open discussion on what else is expected. But largely, we're not seeing this as an area where we have significant practice issues or concerns at all. But thank you.
Okay, great. Thank you very much, Sarah. And we'll move over to Brian Croto.
Great. Thanks. And not to repeat, but probably good just to hear from much of the auditors here. I agree that I don't think the standards need significant change. And I think the way you laid out at the beginning, the concepts between subsequent events, subsequent discovery, fact, and omitted procedures, and other concepts was important. And I think the concepts and the differences are important to retain. But I do believe that where you're seeing some issues in practice, there's often indication that there's something wrong with the company's controls relative to the identification of a potential subsequent event. And I know the natural reaction to that is to say, well, we ought to use technology or we ought to do other things as auditors to ourselves find them. I think we'd be, in many cases, better to find a deficiency in the company's controls if there is one, and identify that and get that fixed first and foremost. Because as you think about the examples that John rattled off, which are only a portion of the kinds of examples you can see in this space, the idea of the auditor going to search for any potential subsequent event, at the very end of the audit before issuing a report in a more comprehensive way than what we do today, which is a fair amount in terms of inquiries, reps, and other things that are done, and a lot of knowledge the auditor gains performing work through the report date. There are a lot of opportunities for auditors to themselves identify subsequent events, but to do sort of a complete search, if you will, may not be the best solution to any potential issues that you are seeing. I also think you want to think about the difference between sort of fraud and versus intentional acts versus an error, and when you're thinking about what any potential response might be from a standards perspective. This is a topic that I may have the year wrong, or I'm sure might correct me if I did, but I feel like maybe it's around 2009 or 10 where this was looked at by the SEAG previously, when the FASB was had updated its standard. There obviously were changes from a financial reporting perspective in the standards, but yet at that point it sort of dropped off the agenda. I think probably because it was determined there really wasn't something that needed to be done versus other things that were priorities on the standard setting agenda, which does not surprise me. So here we are again talking about it maybe 14, 15 years later, and without a lot of noise in that time frame in between. So I think that's all informative to, not saying that there couldn't be modernization of the standards to align to the accounting standards, and to think about whether there's things to do around margins. But I don't think this is an area where there are significant problems with the standards.
Okay, great. Thank you very much for those thoughts, Brian. And John White, we'll move back over to you.
Yeah, I just wanted to go back when I was hearing Christine commenting. I agree with Christine and Stephen and Brian. I think the system works the way it is now. I think that the dance of getting information from lawyers and the privilege issues around that works. So I'm not seeing this as an area that you really need that needs particular improvement. One of the things I guess I didn't mention earlier, there was the question number 2 said, are there places where auditors have identified the subsequent events? I'm thinking that I have seen that occur in the impairment area. I'm not sure I can specifically remember where, but it feels like that is a place where you could end up with auditors identifying it where the company may not have.
Okay, great. Thank you very much for those thoughts, John. And Lynn Turner, we'll move over to you. Oh, you are on mute, Lynn.
Can you hear me now okay?
I can. Great. Thank you.
Yeah, where I've seen the issue is when the financial statements have been issued and then new information pops up. So we're talking about a 560 AU 561 type issue or whatever the subsequent number is. But it's sometimes I've seen it pop up, quite frankly, when the PCAOB has done an inspection. And as a result of the PCAOB requesting the auditor to go back in and perform more work, additional information has come to light that raises question, or where there's a whistleblower and a whistleblower has subsequently come out and has raised issues, and the auditor doesn't always do a thorough investigation with an unbiased perspective, because they know they have the financial statements out there. And if they have to change the financial statements, then they're worried about litigation risk at that point in time. And we certainly seen situations like that. And we're seeing it actually, quite frankly, right now with Super Micro. But those are situations where I think the subsequent discovery could be improved with some better guidance on when that information comes to light, what you need to do in terms of the investigation. I think in situations I've seen, it is a very light touch on the investigation, and it feels like it's being done to avoid the litigation rather than to figure out what the real facts are out there.
Okay. Thank you very much for those thoughts, Lynn. Much appreciated. John White. Oh, you are on mute.
You know, Lynn, it's interesting because I have seen results coming, or things flowing from the PCAOB inspections, but it's not errors in the financial statements that end up being corrected or restatements. What I've encountered more is you have an inspection or preparation for an inspection, and the auditors become concerned because of either what they've been told in the inspection, or they figured out themselves that there may have been potential deficiencies in the audit itself, in the auditing procedures, and so they want to do additional work. I'll call it subsequently, with respect to what potential deficiencies in the audit, the kinds of things that are cited in the report, the 1A reports. And the big problem comes that if they identify that kind of later in the year, they do not want to issue the review reports on the 10Qs. So there are a number of cases out there where the 10Qs are delayed this is actually in the public disclosures. The 10Qs are delayed while the auditors are completing audit procedures with respect to year end. I mean, that's where I've seen the impact, not that you've got subsequent events that result in, I'll say, a restatement or a change in the financial statements.
Okay, great. Thank you very much, John. And Lynn, if you want to go ahead, I think you maybe have a reply to that, and then we're going to move on to the next set of questions after that.
Yeah, just real quick, John, I have seen both of those. One where the financial statements had to be redone, and one where it was, as you said, it was they hadn't complied with PCAOB standards.
Okay,
Great. Thank you very much for adding that, Lynn. Go ahead, Donna, for the second set.
All good. So Brian, you can go to the next slide for me. Thank you. So for our last set of questions, so if you've encountered situations where the date of the auditor's report was different from the date the financial statements were filed with the SEC, what were the reasons for the difference and how did it affect the nature, timing, and extent of the auditor's procedures related to subsequent events? Questions 6 and 7 I'll combine. So for investors and other users of the financial statements, what are your concerns about subsequent events or subsequently discovered facts that you believe auditors can address? And lastly, are there other matters related to subsequent events, subsequently discovered facts, reissuance of the auditor's report, including for registration statements filed with the SEC, or dating of the auditor's report that should be evaluated when considering changes to the auditing standards? So we can open it up for discussion.
And thank you, Donna. I'm conscious that some of these questions we've already heard some discussion on, but if anyone has anything else to add, please go ahead and raise your hand. I'm not seeing any. Oh,
Dane.
Dane, yeah.
I can think of one just from last week. An analyst had noticed that one of her companies had a short report had come out and called into question some of the accounting, and then I think the company was delaying its 10Q either for internal audit or not so much for the external audit, but for the internal audit to do its work. So those are situations where the market has a desire for more information when things are called into question about the quality of the accounting, or even with short reports, it can be hit or miss. Some of those are valid concerns, and many times they're not valid. And I guess when there's opportunity to kind of clarify and separate fact from fiction, those are helpful to markets.
Great, thank you for that input, Dane. Any other questions or comments? Give me a second here. I'm not seeing anything right now. So Donna, unless you have anything else, we'll hand it back over to Barb.
Nope, I'll happily hand it back over to Barb. Thank you, everyone.
Thank you, Donna and Cheryl. And Brian, you do have a great memory. Sue Cosper may also remember that meeting, is that we were focused on what to do in light of FASB, including subsequent events and going concerns and the codification. Thanks again, everyone, for the great discussion, and to members for contributions throughout the day. A special thank you to the Emerging Issues and Auditing Subcommittee. Once again, a great discussion. We have lots to go back and think about. I also want to take a moment to thank some of my PCAOB colleagues who worked very hard behind the scenes to make today possible. From the Office of the Chief Auditor, I want to thank Jessica Watts, Danny Verbeck, and Akiko Upchurch, Matt Sickmiller, Brian Degano, along with our presenters, and the Office of External Affairs, especially Brian Goodnaw and Will de Santiago. This now concludes our meeting. We look forward to seeing you at our next meeting. I'd like to wish you all a happy Thanksgiving, a wonderful holiday season, and a happy new year. And don't be a stranger. We'd love to hear from you if you have further thoughts on any of these topics at any time. You know where to find us. Thank you so much, everyone.